The US dollar. It's a polarizing topic in the world of finance, with many claiming that the end of its global dominance is just around the corner. You've probably heard people saying that the dollar is crumbling, that the world is moving away from the USD, and yes, there is some truth to the idea of de-dollarization, but here's the reality. While there are shifts in the global financial system, the USD isn't going to collapse anytime soon. In fact, it's more likely to strengthen before any real decline happens. Today, we'll be diving into the truth about the US dollar's dominance. We'll look at how the world is slowly moving away from the dollar, why emerging markets are pushing for alternatives, but more importantly, why the dollar remains the safest currency on the global stage. Stick with us, because you'll see why, even in a world moving toward alternatives, the US dollar is far from being dethroned. This video is produced by the team at Capitalist Exploits. Headed by professional asset managers Chris McIntosh and Brad McFadden, the team hunts for deep value assets that are surprisingly contrarian despite strong fundamental cases for potential future appreciation. If you're looking to gain access and insight as to the personal investments of active hedge fund managers and in-depth reasoning as to why they've invested in the assets they're sharing, check the links in the description below. You'll get access to advice on how to allocate, organize, and think about your portfolio, while joining a growing community of people thinking outside of the box. Enjoy monthly updates, open Q&As, regular newsletters, a community forum, organized portfolios, investing education videos, and more with the Capitalist Exploits Insider subscription. If you're not ready to fully take the leap, we also offer the Capitalist Exploits Insider newsletter series for $1 for the first 30 days and $35 a month thereafter. Do note, our investing strategy and philosophy can deviate a lot from the mainstream. We offer a money-back guarantee regardless, but make sure you're on board with our investing philosophy and global outlook before deciding to join us. Let's start with the big talking point, the global shift away from the USD. Yes, it's happening, but let's be clear, it's not as fast or widespread as some might think. What we're seeing is mainly driven by emerging markets and nations like Russia, China, and the BRICS bloc. These countries have clear incentives to reduce their dependency on the USD in trade and finance. But why now? It all boils down to geopolitical pressure. Take Russia and Iran, for example. Both are heavily sanctioned by Western countries, and their access to the international financial system, which is largely USD based, has been restricted. This has pushed them to find alternatives, trading in their own currencies like the yuan or the ruble. The rise of bilateral currency swap agreements is one way they're bypassing the dollar. For instance, China and Russia are increasingly using their local currencies for trade, while the BRICS bloc is discussing financial systems less reliant on Western banks. However, we must make a key point. While these countries are making moves to de-dollarize, the process is slow and fragmented. Even nations actively seeking alternatives still hold a significant chunk of their reserves in USD and conduct much of their trade in dollars. Why? Because the dollar is still the most liquid and widely accepted currency in global finance. Sure, China is pushing the yuan as an alternative, but the yuan's convertibility and China's capital controls prevent it from becoming a real challenger to the USD's reserve status anytime soon. And the ruble, well, it's too volatile and dependent on commodities to be considered a stable alternative. So, while the global shift away from the dollar is real, it's slow, fragmented, and most importantly, it lacks a viable alternative. Now, let's look at why, despite these global efforts, the USD remains the safest bet in the world of fiat currencies. Here's where the conversation takes a turn. Despite all the efforts to move away from the dollar, it still stands as the safest and most liquid fiat currency in the world. There's no getting around the fact that the USD is deeply entrenched in global trade, finance, and most importantly, debt. One of the key factors supporting the dollar is USD-denominated debt. A significant amount of global debt, particularly in emerging markets, is denominated in US dollars. This means countries and corporations around the world need to hold dollars just to service their debt obligations. This structural demand for USD creates a permanent floor of demand, even for nations that are looking to reduce their reliance on the dollar. And then, of course, there's the US Treasury market. the most liquid financial market on the planet. When markets get turbulent and uncertainty takes over, investors flock to US Treasuries as a safe haven. This flood of capital into US bonds boosts demand for the USD, strengthening the dollar during times of crisis. Add to that the fact that central banks around the world still hold large reserves in USD, and it becomes clear why the dollar remains dominant despite the challenges. It's not just about geopolitics, it's about liquidity and scale. Even though there's growing interest in using the euro or yuan in international trade, these currencies don't offer the same trust, liquidity, and global acceptance that the USD does. The euro suffers from sovereign debt risks and economic disparities within the eurozone, while the yuan is held back by capital controls and transparency issues in China's financial system. Without a credible, scalable alternative, the USD remains firmly at the center of global finance. So, if the USD is the safest and most liquid currency out there, what's happening with the other major fiat currencies? Well, some of them are in trouble. Let's take a closer look at the euro and yen in particular, and why they're struggling to keep up. The euro and Japanese yen, two of the world's most traded currencies, are facing their own systemic crises. Let's start with the euro. The eurozone has a structural problem. Sovereign debt crises in countries like Greece, Italy, and Spain have exposed deep flaws in the currency union. These countries have struggled with debt control, and the resulting bailouts and financial instability have shaken confidence in the euro's long-term viability. As economic and political tensions rise within the eurozone, we're seeing capital flight from the euro into USD-denominated assets, further weakening the euro's position. And then there's Japan, where the yen has been in a long decline. Japan's economy has been stagnant for decades, and its ultra-loose monetary policies, including negative interest rates and aggressive quantitative easing, have further eroded confidence in the yen. Japan is also grappling with a shrinking workforce and aging population, all of which make it unlikely that the yen will regain its former strength. Meanwhile, Japanese government bonds, JGBs, offer next to nothing in yield, which makes the yen even less attractive compared to the higher yields available on USD-denominated assets. In short, both the euro and yen are stuck in a downward spiral. The USD, by contrast, continues to benefit from the structural weaknesses of these other major currencies, cementing its role as the global safe haven. But what if fiat currencies as a whole are in trouble? While the dollar stands strong among its peers, some investors are looking for alternatives to fiat itself. Let's take a quick detour and look at why gold is becoming a hedge against fiat currency instability, and why it makes up another one of our themes at Capitalist Exploits Insider. Links in the description below. Even though the USD remains the world's reserve currency, there's growing concern about fiat currency stability. This is where gold comes in. For centuries, gold has been seen as a store of value during times of uncertainty, and today is no different. In fact, central banks, especially in emerging markets like Russia and China, are increasing their gold reserves as part of their strategy to diversify away from the dollar. Gold acts as a hedge against both currency devaluation and financial crises. For countries like Russia, which has been under sanctions, gold is a way to decouple from the US financial system. Moreover, there are talks about some nations fracturing the petrodollar system by using alternatives like the yuan or even gold-backed trade for their oil transactions. While this trend is still in its infancy, it signals a growing movement away from the US dollar in global trade. So where does this leave us now? Even with the rise of gold and alternatives, the USD remains the dominant force, especially in times of crisis. Let's take a look at why the dollar strengthens during periods of market volatility. In terms of global market volatility, the demand for US dollars doesn't just rise, it skyrockets. The USD is the world's reserve currency for a reason, and its role in settling global debts makes it an indispensable asset in times of crisis. This is especially true for emerging markets, where a significant portion of debt is denominated in dollars. When financial crises hit, whether it's due to a downturn in commodity prices, a debt default, or political instability, countries and corporations scramble to buy dollars to service their USD-denominated obligations. This rush for dollars further drives up the value of the USD, creating a self-reinforcing cycle of demand. But it's not just about settling debts. The USD's status as a safe haven currency extends across the entire global financial system. In moments of stock market crashes, sovereign debt crises, or bond market instability, investors flee to the perceived safety of US treasuries. And since treasuries are denominated in USD, this flight to safety naturally pushes up demand for the dollar. Whether it's a crisis in European bonds or turbulence in Asian equity markets, the USD becomes the currency everyone turns to, further solidifying its strength in uncertain times. One of the key factors reinforcing the USD's strength during these periods is the yield differential between the USD and other major currencies. The Federal Reserve has consistently taken a more aggressive stance on interest rates compared to the European Central Bank or the Bank of Japan. With higher interest rates in the US, USD-denominated assets, particularly treasuries, offer more attractive returns. This widening gap in yields attracts more global capital into the US dollar, driving its value even higher. In short, during periods of market volatility, the US doesn't just hold steady, it gains strength, fueled by demand for safety, debt servicing, and higher yields. This makes the dollar an unbeatable safe haven when uncertainty strikes. So, is the US dollar going to crumble just like that? Not even close. While there's a slow, fragmented shift toward alternatives, the USD remains the safest, most liquid currency on the planet. Global trade, debt, and financial markets are still deeply entrenched in the dollar system, and until a true alternative emerges with comparable liquidity, trust, and scale, the USD's dominance will continue. The key takeaway? Don't bet against the dollar just yet. Whether it's in times of crisis or during periods of global uncertainty, the US dollar is still the best hedge for investors looking for safety. While the world explores alternatives, the dollar's entrenched position and yield advantages make it the go-to currency for the foreseeable future. The USD is one of the many themes or portfolios that we feature in the Capitalist Exploits Insider members section. To gain access to the specific companies we're looking at, and even more in-depth rationale and discussion about the USD and other currencies, check out the links in the description below. The research used in this video is available in the description below, and thank you so much for watching, and remember to stay informed.